It's been a painful start to 2022 for investors of all kinds, from bond investors to stock investors, but particularly for growth stock investors. So in this video, we're going to talk about duration of equities and specifically how that has impacted growth stocks versus value stocks in 2022. And I think understanding this concept will give you a much better understanding of why the market is acting the way it is in 2022 and help you make a more informed decision on what to do about it going forward.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
So let's assume we've got two different types of stocks. We have a growth stock and we have a value stock. And then we're also going to include the US Treasury. This is the 10-year US Treasury yield. So here is the start of 2022's metrics for each one of these stocks. So we have the growth stock. Let's say it's trading at a PE of 66 times. And the value stock, let's say it's trading at 10 times. And then the US Treasury to start the year was at 1.5%. So what will happen to each one of these stocks if interest rates go from 1.5% to 3.1%, which is where they are as of May 9th. It's much easier to see this relationship if we convert price to earnings to earnings yield, which is simply, instead of taking P divided by E, we're taking E divided by P. So a stock trading at a 66 times PE has an earnings yield of 1.5%. A stock with a 10 PE has an earnings yield of 10%. Now it's much easier to compare these two to the Treasury, which we've got still at 1.5%. So what happens if we make the 10-year US Treasury go from 1.5% to 3.1%? How will that affect the earnings yield of each one of these stocks? Let's create a bit of a chart. That looks terrible. Try that again. Here we go. So we've got on one chart yield, and on this chart we've got time. So on January 1st of 2022, we had the 10-year US Treasury at 1.5%. We're going to put this over here, 1.5%. And we had the value stock at a yield of 10%. Then we also had the growth stock at an earnings yield of 1.5%, just like the US Treasury. So now let's fast forward to May 9th, 2022, and the 10-year US Treasury has basically doubled to 3.1%. So the question is, what is going to happen to the earnings yield of these two stocks? Well, we can't know exactly, but let's just assume that the earnings yield for these also matches exactly the relationship that it had prior to yields going up. So in the case of the growth stock, we had the earnings yield equal to the US Treasury yield. So we can calculate that the earnings yield now with the 10-year at 3.1 is going to match the earnings yield of the growth stock at 3.1. We'll assume that the relationship between the value stock and the 10-year US Treasury remains constant. So here we had 10 minus 1.5, or an 8.5% spread between these two numbers. So if we assume this relationship stays constant, the new earnings yield for the value stock would go from 10% here to 11.6% here. So the relationship still stays at 8.5. So let's go back to our chart here and we can plot our new earnings yield. We had the growth stock at an earnings yield of 3.1. The value stock at an earnings yield of 3.1, and of course the 10-year Treasury at 3.1. So let's convert this back to PE ratio. We simply take 1 divided by the earnings yield, or in the value stocks case, or excuse me, the growth stocks case, it is 1 divided by 3.1, and that is 32.5. We can do the same thing with the value stock. Its new PE would be an estimated 8.6 times. So now we can calculate the estimated impact on the actual stock price from this change in yield. So the growth stock went from a 66 PE to a 32.5. That would be a reduction of 51%. The value stock went from a PE of 10 to a PE of 8.6. That would be a reduction of 14%. And so the market's reaction here, I think, is more telling us about the valuation component, the discount rate of how the market is thinking about these stocks in relation to interest rates. It's not necessarily, at least not yet, telling us that much about fundamental changes. So what we need really to stabilize this market is a stabilization in the 10-year US Treasury yields. If we can get that, I think you could see stocks in general and growth stocks in particular make a little bit of a comeback. Of course, this is all dependent on whether the economy goes into a recession or not. If it does, and you get the E part of the equation starting to decline, then you could see a more substantial reduction in stock price beyond just changes in PE. But at least at this point, most of the destruction in 2022 has been a PE compression rather than an E deterioration. Thanks for watching, and I will see you in the next video.